Good morning, everyone. Thank you so much for joining us on this webinar this morning. It's the second in a series of webinars that we've been doing on the post-pandemic world. This morning, we've got a great panel to lead our discussion, and I'm going to be introducing them all to you shortly. First thing to say is that this webinar is being recorded, so we just need you to know that it will be recorded and will be available afterwards. So without further ado, I'm now going to introduce you to our panelists this morning. For those of you who don't know me, I'm Karen Mason. I'm one of the founding partners of Newmanor Law. This morning, I'm also joined by my partner, Alex, and Alex is going to be in charge of the roving mic and will interject with questions as you raise them at appropriate points in the discussion. We've also got with us Tim Richards, who is a director of Aston Rose. Aston Rose are chartered surveyors, and Tim has been advising both landlords and tenants for over 35 years. Tim, I'm sure you can give a better introduction of yourself than I've just done. So over to you, Tim.
Yeah, well, good morning. Good morning from sunny Shropshire. I hope I'm not blinding you. It is particularly sunny here this morning. And yes, I guess on topic, I'm working from home at the moment. Just this morning, as we get a much better experience on these calls. I run the agency team at Aston Rose. We advise many landlords, many tenants across all sectors. But particularly office is a very busy sector for us at the moment. And the comments you hear from me later on will be informed by my conversations particularly with my occupier clients as to their views of the future and what they're looking for.
Good, thank you, Tim. We also have with us this morning Lettice Swan. Lettice is an associate director at MDA Consulting. And I'm going to let Lettice introduce herself as well.
Thanks, Karen. Morning, all. So I'm responsible for looking at the new business opportunities, both in London and more generally the Southeast at MDA Consulting, and have been doing so for nearly 7 years now. So if you've not come across us before, we are a quantity surveying and project management firm that also offer building surveying, monitoring surveying, principal designer services, amongst several others. We're predominantly a UK business. We've got 7 offices dotted around England and Wales, and we do work on quite a huge array of different projects, both very small up to very, very large, and everything in between, across quite a large number of sectors. I guess key for us at the moment is commercial, obviously, residential in all its guises, student residential, housing association work, luxury one-off homes. If someone lives in it, we'll get involved in it. Hospitality and industrial have been on the rise as well in recent years, so that names a few. I assume that most people sat on this webinar today are fairly interested in office development. If so, I'll be attending the BCO conference up in Manchester next month. So if anyone else is also heading there and would like to continue today's discussions, then do get in touch.
Lettice, thank you very much. And our last panelist is Tim Shuey. Tim is the founder and managing director of Fifields Finance, and I'm going to let Tim say a few words to introduce himself. Over to you, Tim.
Karen, good morning, and thank you very much for having me today. Fifields Finance is an established debt broker. We're assisting real estate developers and real estate investors in the optimization of their capital structure for their investments. Our real estate finance team previously traded under the umbrella of Capita and Link Group, and we completed a management buyout in October 2021.
Thank you, Tim. So you've now met all our panelists, and before we embark on our discussions, we thought it would be very good to kick it off with a couple of polls. And so we're going to run our first poll this morning, which Kelly will line up for us. And we want you all to be ready at the draw. So what occupancy do you think offices are currently nationally? So all vote now, please. So here are the results straight away. So in terms of most of your votes, 53% said between 25 and 50%. So that's interesting. That's the highest percentage. And between 50 to 75, 35%, less than 25, 12%. So it'll be interesting to see how that comes out, because I think Tim, in our discussions next, is going to touch on some very up-to-date stats on that area. So what occupancy do you think offices are currently at in the City of London? So slightly different voting here, but the highest percentage is still between 25 and 50%, and the lowest is less than 25. So that will be very interesting to see what our discussions reveal and how that compares with the two polls that we've just ran. So Tim, over to you. Is the office dead?
Yes, good morning. Well, is the office dead? I would argue firmly it is not. Mind you, it is carrying an injury. Now, let's separate sentiment from hard data, which I think is why we've just all done that poll. Some of you may know Remit Consulting publish every couple of weeks a survey which shows precisely what office occupancy looks like. And the last one, which came out tail end of last week, which covered the second week in May, showed that across the whole of the UK, office occupancy is at 28%. So only just into that second tier that we just looked at in the poll. In a London context, Mayfair is doing best. Mayfair was about 33%. The City and Midtown are only just hovering just above that national average. And of course, the question you might have asked was, which day of the week are we referring to? Because that data also covers that. And perhaps you won't be surprised to hear that Tuesday, Wednesday, Thursday are the busiest days of the week. Monday falls back a little bit. And on Friday, occupancy just 17.5% across the country. So that average desk across the country is only being used for about a day and a bit each week. And I'll offer you one more statistic, and that was a CBRE survey this week, which asked businesses how likely they were to offer hybrid working to their staff. That percentage has been creeping up with each survey, and that figure this week stands at 75%. So 75% of businesses say that they will offer hybrid working to their staff. I advise many occupiers, and all of my clients are asking themselves this question. Yes, we realise we do need a physical place. However, what should it look like? Where should it be? And how much of it do we need? And certainly that last point is a pretty important one.
Yeah, and we'll come back to that point as well as we go along in the discussion. And Lettice, what do you think? How does the picture regionally differ?
I think certainly anecdotally, like I said in my introduction, we've got 7 offices dotted around the UK, so 6 outside of London, other cities such as Manchester, but other areas are sort of more regional, such as Hove, and Leicester. And I really don't think the rush to work from home was nearly as acute in the regions. I think public transport often played a part right at the start. I know for us, a couple of our offices were maybe a little bit dated. So people had individual offices, which was obviously preferable at the start to stop transmission of COVID. I think it's balancing out a little bit now, but yeah, I think it's very much more of a London-centric or capital city-centric this year, working from home.
Yeah, very interesting that there is such a contrast between the experience in London. And I suppose the other thing that must influence that is obviously the cost of commuting into London. But let's now turn to Tim Shuey and get the investor view on all of this, because that's such an important view as to what are investors thinking, what are they doing at the moment, Tim?
Yes, thank you. Well, according to CBRE, the Central London investment volumes in the first quarter of 2022 were at a record high at £5.5 billion. That is the highest first quarter that was ever recorded. And the largest deal was, of course, the 5 Broadgate deal, which traded for 1.2 billion to a Korean pension fund, which was the 4th biggest price ever paid for an office building in central London. Overseas investors dominated the quarter, and they were accounting for 83% of all purchases. And Asia in particular was the single most active region in the central London investment market during that quarter, accounting for about 2.5 billion of the total 5.5 billion spent. So this kind of seems at odds with some of the trends we've been seeing emerging, with some arguing that those deals we just spoke about were arranged in quarter 4 21, and that there has been a delay in realization of the new headwinds the market is facing since the beginning of the year, namely the short-term interest rates rises we've seen from the Bank of England to 1%, and the financial markets anticipation that the bank would raise interest rates further up to 2.5%. Moreover, the Bank of England stopped its 900 billion quantitative easing program that it started in 2009 after the last financial crisis, which is causing long-term interest rates to also increase at the long end of the yield curve. And the war in the Ukraine is fueling energy price increases and is causing geopolitical instability. The lending market is adding to those negative trends. In times of uncertainty, we see banks tending to retrench by focusing on their existing clients and lowering available LTV ratios to new business, thereby drying up liquidity in the market. We've seen the return of swap rates and caps that went out of fashion after the last financial crisis in 2008, increasing the cost of borrowing. And in a recent exercise we did for a client, we sought financing for 3 London office trophy assets, and the overall cost of capital was close to, if not above, the net initial yield based on the asking price, suggesting that negative leverage is a real possibility, a scenario which is obviously unsustainable over the long run. So what does all this mean for the London office investment market? Well, the simple answer is at times when interest rates go up, asset values have to fall. And there are 2 very interesting live transactions in the market at the moment, which may give us a clue as to where the market is heading. Both transactions are seeking asking prices below 4% net initial yield, and it remains to be seen at what levels they will trade, and maybe more interesting even when they will trade. It's 21 Moorfields, a sale by Landsac with a 25-year lease to Deutsche Bank directly above the Crossrail station in the city, and 1 and 2 South Bank, a sale by Alma Kantar, which features the new Shell headquarter and a 15-year plus WeWork lease, which is interesting enough from other dimensions as well. And what will happen next really will depend on the view that investors are taking on the London office market as a whole. If investors believe that interest rates are staying up for the foreseeable future, sellers will need to accept that their offices will be worth less than they were at the beginning of the year. This would inevitably lead to a price correction in the market, and that will be reflected in higher yields. And there are probably very good reasons to believe that interest rates will continue to go up or stay up, such as high inflation, mainly caused by the recent energy cost increases and an overheated labor market with spiraling wages. But there are also other investors who believe that interest rates are temporarily increasing and they will need to fall again. And they think reasons for that are a contracting economy that we're about to face and the danger of killing the patient. The government has borrowed vast sums of money during the pandemic, and the UK's gross debt currently stands well north of 100% of GDP. And in such a scenario, investors might be able to look past the current interest rate spike, as index-linked rent schedules combined with expected capital gains will continue to make London offices look like an attractive asset class. So only time will tell, and we at Five Fields Finance believe that markets may take a little breather from the record numbers seen in Q1 until there's a little more certainty in the market.
Thank you very much, Tim. And I think the points that you've made on interest rates lead us conveniently into our next poll on interest rates. So how high do you believe interest rate will rise this year? Let's see where this comes out. So the predominant vote is 2.5%. There's only 12% of people who think that interest rates will go higher than 3%. 29% think that it will stay at 2%. So interesting spread there, really. As you say, Tim, only time will tell where we're going to end up on that. So Lettice, what do you think that occupiers are looking for? You know, what are the new must-haves out there in the market? You know, what are tenants saying that we must have?
Well, I think the emphasis at the moment is really getting people back into the office. So decent space is at a premium, as is energy efficient space. I think shorter leases with more flexibility, more rent-free periods, we're seeing more of. On the space side, I think we were moving pre-COVID into tenants looking for less space because more people were hot desking, and now we've done a bit of a U-turn. You know, sharing desks at the height of the pandemic was obviously a bit of a hotbed for contracting COVID and passing it along. So actually, maybe some people are looking for marginally less space. I don't think it's a key thing anymore. We are noticing a slight increase in people subletting. So taking maybe the full plate that they'd always taken prior to COVID, and now subletting a certain percentage, probably a fairly small percentage of their desks to another firm to, you know, take some of the rental strain, basically, especially when, there's tricky times ahead, lessens the risk.
Tim, do you want to come back in here? Have you got any contrasting views?
No, not so much contrasting, but certainly without question, there's a drive towards quality for occupiers. And at the heart of that is the employment issue. For businesses, you know, their employees are the heart of the business. Employee churn is a big cost for businesses, and in a marketplace where it's clear, if you look at the figures, that it's going to become harder to employ people. If you can make your offices nicer for your staff, and more importantly, this is a factor that that Lettice didn't mention, I think closer to public transport is a plus, because obviously the more accessible you are, the bigger the net you can cast when looking for new staff. But can I just move on to sort of what I think is probably a key question, and that is, are occupiers going to need less space? And I'm going to give a big resounding yes to that question. And I'm going to throw my second lot of data out there now. And that is CoStar, which is the sort of property industry's data provider, shows how much space is being let each quarter, and importantly, how much space is being handed back to landlords. And we see a lot of headlines in the press about big deals being done, but very often those articles don't talk about the space that's actually been handed back by those same tenants. So out of the last 9 quarters, all of those quarters bar one have seen a lot more space handed back to landlords than has been taken by tenants. In 4 consecutive quarters, that was over 1 million square feet, negative 1 million square feet of net absorption, as CoStar call it. And that has seen the vacancy rate in London, I'm talking about the London market at the moment, that's doubled from the start of the pandemic. So that's gone from sort of circa 4% to 8.2%. And in some markets, the City, Midtown and Docklands, that vacancy rate is 10% plus.
I'm going to bring...
And I would argue this is only just starting, because most businesses, particularly large businesses, are not that footloose, and it takes them a while to get their act into motion for dealing with these sorts of things. Your average length lease is 5 years, so you can't necessarily take action straight away. So I think we're going to see a drive towards quality and a lowering of quantity of space which is required.
That's an interesting point, Tim, and I'm going to bring Alex in now, because Alex with the roving mic, I think, has a question for us.
Yeah, morning everyone. So in terms of these features, quite interesting. Someone's picked up in the comments about demand for space being around London terminals, which was just mentioned as being a sort of area to look at. But is there a tension between, in terms of the office economics of bringing people back in, there's this term that's been used, hotelization of office space, versus actually improving affordability by stripping out the frills for some occupiers? Does someone want to comment on that? Where is the line, and are some people actually bucking this trend to make spaces actually plusher by looking at the affordability?
Well, as an office agent, maybe I should comment on that one. I mean, obviously, you know, there are lots of different occupiers out there, and there's lots of different drivers. But I'm seeing very little demand for economic, poorer quality space. Occupiers seem to be taking the view that we're prepared to pay more per square foot, but we'll take far less square footage than we used to have.
That's very interesting. And I think actually that's a very good point to run our next poll on features. Which features of the office space would be most likely to draw you back in? So I think this is quite an interesting one. Firms are been enticing people back in with hot food, meat and 2 veg. Is that something that will get you back into the office? Well, apparently not. It's much more likely to be gyms, showers, changing areas, outdoor terrace, nearby outdoor green space. So, I mean, I think that's really interesting, isn't it, to show that those are the things that are going to be interesting.
Yeah, and Karen, if I may chip in on that, I think location will become ever more important, but not in the classic way that we know location by, but the flexible office seems to be introducing workspaces outside the more traditional working centers, where workers have the closeness and flexibility to reach pretty much everything they need within a 15 minutes commute, be it, you know, their home, the commute to the office, amenities, shopping, whatever it might be. And so in addition to what Tim Richards just said, I think location as to the flexibility to work from wherever, be it in an office or at home, but have everything else that you may need will become significantly more important for large cities such as London.
Mm, mm. And
Aaron,
so,
if I can just add in there, yeah, we're seeing a lot of larger employers going for a sort of spoke and hub style pattern. So a much shrunken headquarters function in central London, and then they are providing offices for their staff close to where their staff live, where they will work sort of 2 or 3 days a week and maybe come into the head office function once a week.
so I think what we're really saying here is that the employment, the current employment market will have an influence on the office sector, and that's going to be quite marked. And the sort of what the big employers do, particularly, will influence the office market as well. Lettice, do you want anything else you want to say on this?
Not on this.
All right, okay. All right, so why don't we run our next poll on space and see what we're saying on that? Do we believe that occupiers will require less office space in the near future? So yes, I mean, there's a resounding 81%. So I think you've definitely led the witnesses there, Tim. No doubt about that at all. And then let's go for our next poll as well on recruitment. Do you believe it has been easier or harder for employers to recruit staff post-pandemic? There's a resounding 78% that thinks that it definitely has been harder. Why do we think it has been harder to recruit staff post-pandemic?
I think on one hand, there's actually been a huge increase in candidates on the market. It's sorting the wheat from the chaff more than ever that's become really tricky. I think whenever there's a recession or a pandemic or some sort of huge upheaval in society, companies can Brexit vote as well. Companies can use it as a bit of an excuse to get rid of the dead wood, should I say. So then more candidates come on the market, and you interview people maybe once or twice to really get under the skin and find out if they're going to be a good fit for the office. People are so switched on, they know what to say in an interview, they know what the interview wants to hear. So that's what we've really struggled with. We've taken some very good staff, to be fair, but then there have been a few occasions where they've talked the talk and they've walked the walk in a couple of interviews. And then they've come often, and I don't want to sort of name and shame, but from the larger, more corporate QS practices, where people can hide away a little bit if they're not up to the job. So yeah, at the start there were a lot of people, or once furlough ended, should I say, there were a lot of quantity surveyors and project managers looking for work. To find out why they were looking for work, that was the harder thing to assess.
Yeah. Tim, anything from you?
Yeah, and at the same time, I think we can hear that both in the UK and in Europe, interesting enough, there seems to be quite a lack of skilled labour in volume. And what we could read yesterday in the FT, especially at the high end, I think entry levels for Clifford Chance lawyers now stands at a staggering £125,000 salary before packages. So all this gives employees significant negotiation power to negotiate not just who they want to work for, but how they want to work, which then comes back to the conversation we are having just now. And it also gives central bankers a real dilemma, because wages and salaries spiraling ever higher can actually be met by interest rates and using interest rate, rising interest rates. But the overall economy is turning in exactly the other way. And so being a central banker at the moment, it is not an easy job. It cannot be, because they have to manage the interests of the economy as a whole, and also catering for a labor market that is clearly overheating and spiraling out of control.
And that's a very difficult balance to hold, really, and one that is going to be very challenging going forward. Alex, I'm coming to you because you've obviously got a question on this with the roving mic.
I do, just to sort of bring together this idea of the employees banging the drum. Isn't part of this as well the benefit of the office space as a collaborative space? Because I don't think anyone's mentioned that really yet, and whether we can't lose sight of that really. And anecdotally, fit out people that I know, people who supply furniture for some of the big spaces, are saying collaborative spaces are really key. That's what they're seeing an uptick in, and so really, isn't that a big point to push as well for the office space?
Tim, do you want to come in on this?
I would just say yes. Collaborative space is important. It's one of the reasons why you want to get staff into the office. And in terms of design, add that on top of that. Maybe we're living proof of that right here and now. Things like Zooms and team booths and rooms as well is going to become increasingly important. Yeah.
And I think this is a very good point now to look at another aspect of offices, which I'm convinced will start really influencing the market, and that is energy efficiency. I mean, how do we think, how important will energy efficiency be, both to, to all the different classes, really, to tenants, to landlords, to investors? I would think that, energy efficiency will become increasingly important. I mean, what do you think, Lettice?
I think the whole sustainability conversation has been coming to the forefront more and more over recent years. I think that accelerated in our industry a fair bit since COVID. I think a few years ago it was sort of nice to have, whereas I think now questions about BREEAM and EPCs are being raised fairly early on in the letting process. Companies are more switched on. They don't want to be seen as greenwashing, so singing their energy credentials, but then behind closed doors aren't adhering to them themselves. I think, as we've spoken today on other points as well, just poor quality and inefficient space will just end up being let for the bottom end prices. We do an awful lot of work for the banks funding developments when we act as monitoring surveyor, and I know they very much have a view on this, although Tim Shuey might be better placed to talk in a bit more detail on that front.
Yeah, so thank you, Lettice. And I just want to pick up on the previous question, because I don't think anybody has cast judgment that the office may be obsolete. I'll just give an example of ourselves. 5 Fields Finance is as a newly incorporated business. There's only 3 of us at the moment, so we can well do without the additional costs of an office. So right now, working from home with people who've worked together for years, know each other very well, know what they're doing, this works for us. However, as soon as we grow and hire new candidates, we will be looking for space that brings us together, where we can sit next to each other, train each other, talk things through. So I don't think there's been a mentioning here that the office is obsolete altogether. And in terms of the EPCs and energy efficiency going forward, certainly at the top range of the market, we have seen lenders making it a requirement to have sufficient energy ratings in place before they would hand out a loan. So the top market of the office range is certainly sort of ahead of the government requirements out there to be carbon neutral. It's just something that borrowers will have to provide going forward if they expect to see debt on their investments. And that will inevitably trickle down from, the top end of the market to the middle market and eventually to the bottom market as well.
Yeah, and I think that we are already seeing that lenders are much more aware of energy efficiency, and I think those buildings that have poor energy ratings will potentially trade a lot. It will be a lot harder to trade those buildings. Tim, do you have anything to add?
Yeah, I think it's important to say that I think there's very much a big and small organisation disparity here. Bigger organisations are much more focused on this. Smaller organisations, smaller landlords are not really particularly aware of the energy efficiency issue just yet. And in a way, perhaps it's not surprising, because if you're a small occupier taking a 3-year lease, you're not going to be around when the requirement to hit sort of C and B come into place. But certainly landlords should be very, very conscious of this, and I'm finding a lot of the smaller ones aren't.
Yeah, well, I think this is a very good point to see what our audience thinks. So how important do you think energy efficiency is in an office to an occupier? So 44% say that it's important, and 33% say it's very important, and we only have a 22% who say that it's less important. So I think that gives an interesting spread, actually, but most people think that it is important in some way. So I think that will probably be one of the things that will definitely change with time as well. So let's switch our discussion now to, interventions. What interventions do we think could, improve matters? What interventions are going to entice people back in? So, Tim, I'm coming to you first.
Sure. Well, frankly, I think there's very little that national and local government can do. I don't think it's really in their gift. This is fundamentally the relationship between the employer and the employee, and the employer has to probably use carrot and stick incentives to encourage staff to come in.
I suppose the other thing that we've seen slightly in the legal market is the sort of the beginning of the operation of two markets: those who work remotely and those who come into the office. Lettice, I'm coming to you next. What's your view on?
Well, I completely agree with Tim on that front. I think it's just so important to be seen, and people will miss out on job opportunities. And I think we'll see a real sort of kickback in a few years' time, and we'll be able to sit back and say that, oh, this has happened all because of the pandemic. But I think in a way we're still in it. But it's those younger guys that are really missing out, and sort of encouraging them back into the office is for their benefit, I think, more so than an employer's benefit.
Yeah. Tim Shuey, anything to add?
Not really, Karen, on this one. Thank you.
All right. Okay.
Karen, can I just pick up on that word networking as well? That's an important thing. Physical networking is something that we've all got to get back to, and the younger generation in particular probably weren't particularly good at it even before the COVID came along. But we've got to get back to that, and the sort of the younger parts of our businesses have got to understand that that's one of their functions, and they can't do it from sitting at a computer.
Yeah, I think that's a very interesting point. And recently, I've seen a couple of organisations really having a go at getting their younger folk to really start thinking about that and start going for events to interact, almost a sort of you know, starting that training again of saying you've all got to interact as groups and get your young connections in across the door to you know, get that discussion going. I can see Alex with his roving mic. So Alex, let's come to you.
Hi there. Yeah, just looking at this interventions from the occupiers' point of view, and I suppose the market is masking some of the downturn with rent-free, etc. But we've had a question around if 75% of businesses allow hybrid working and most staff prefer the middle of the week, the Tuesday to Thursday, how is it impacting rents? Will we see that filter through? Should you be paying for 5 days? Should you be paying for 3, really? That was something. Is that going to coming through? I suppose it's linked to the flexible leases somewhat.
Well, rents, that's probably me, isn't it?
Yeah, it is, Tim.
Yeah, well, at the moment, we're not seeing headline rents falling particularly, but if you burrow underneath the figures, you'll find that sort of certainly net effective rents are falling, and that's because landlords are having to give away a lot more rent free. They're having to sort of sometimes carry out works for tenants. Plug and play is becoming much more of a feature, and obviously there's quite a considerable upfront expense for the landlord in creating plug and play space, and for the tenant a considerable saving in their moving in costs. Are rents going to fall? Again, I would say as a generalism, yes. But of course, the market's always made up of lots of different subsectors. And I suspect that rents are going to stay much stronger at the quality end and in the best locations. And they're going to fall faster for poorer space in secondary locations.
That's very interesting. And, you know, again, as the market unfolds, because the one thing we know as well that, you know, it does take a while for these changes to really work through the market. And quite often it you know, there is a bit of a lag while the market catches up with these things. I think the one area that we haven't covered, and I'd like to cover in the last 10 minutes or so, is you know, looking at alternative uses. We've seen lots of discussions about repurposing offices. How do we think alternative uses you know, will fare, and how will that impact the office market?
Well, we've seen for years offices being repurposed into residential under permitted development. I think the conversation more recently on that side is around quality. I know there's been some very poorly built conversions. However, some have been done fantastically. More recently, I think we've seen hotels and student accommodation coming into old office blocks. But actually, again, I don't want to hark on about COVID too much, but one of the something that we've seen that's definitely a direct correlation from that is care homes coming into city centres, and I guess small office blocks are prime for that. We've been seeing more and more really properly mixed use buildings. So, for example, we've been involved in a school with some commercial and residential, or we've seen a hotel with some commercial and some service apartments. So where that seems to be a growing trend, I think real mixed use generationally communities are on the rise, where we often stuck our old folk out in fairly remote locations when it was tricky to see your relatives at the best of times. I think we're realising that it's actually a very good thing to bring older people into town centres and city centres, and that makes a real successful community.
Yeah, again, even before COVID, we saw a sort of fairly clear pattern of unpopular buildings in the wrong places being repurposed for residential, student use, hotels, and I'm sure that's going to continue. One thing that I've thought about is the government brought in this new Class E use, which sort of unifies offices, light industrial, and all sorts of other uses. I wonder if they're ahead of the game there. I wouldn't be surprised to see some buildings become much more multi-purpose. The sort of the last minute delivery markets, the light industrial market, they're very strong at the moment. And yeah, perhaps we're going to see uses like that coming into buildings that used to be exclusively for office use. Medical and life services, we're seeing a great growth in that at the moment too. But I'd add one note of caution. Normally when an office building gets repurposed to something else, you don't see the same capital values that you saw before. This is usually a question of trying to recover some of the previous value rather than to maintain it.
Yeah, and I suppose the situation will vary regionally, because I think the other thing regionally there are sort of buildings which are much more mixed use, much more I suppose community use as well, on a regional level, as opposed to central London. So I think the position locally and the position in town is likely to continue to change. I think this is a good time actually to run our next poll, which is really a contrast of what's happening in the City of London and what's happening regionally. So what will encourage occupiers to return to the City of London most? Flexibility of leases, that's the top vote. I think cheaper transportation is another very interesting one. I know one of the points that's been made out there is that those families who have large commuting costs have now reallocated their cost of commuting to other parts of the family budget. So part of the challenge in terms of getting people back into the city, I think, does relate to transportation costs, because if families have reallocated that budget, they're going to look very hard at having that spend. I know I was talking to one of my mates and she said, "Oh, I'm staying at home this week because I'm saving money. It's I don't want to go back. I don't want to go into the office and spend the commute money. So I'm saving money by staying at home this week." So I think that transportation and the cost of commuting is a factor, particularly for those with longer commutes who are now looking at how they use those funds. So we're coming up to our last poll, which is how many days back in the office will we be up to next year? So 3 to 4 days has it on 47%, and 1 to 2 days is at 37%, and notably 5 days is way down at 11%. So I think that's a good reflection of where we are really, which is very few people see themselves back in the office 5 days a week. So we're back to how we make the economics of all that work, because it's a lot of this is visualization. How many people really see themselves going back to 5 days a week? I think the challenge for the office market is that very few people see that as 5 days, and so I think it's a good indication that hybrid working is actually here to stay, certainly in the short term. In the medium to long term, I think it's something that we'll have to continue to look at. We're coming up to our closing points, and so I'm just going to give our panelists the opportunity to say their last few words, and then we'll close out. Our aim is to close out on time as promised, to get you all back at your desks soon after 10 o'clock. So I'm coming to you first, Tim Richards.
Okay, well, here's the smallest poll ever. My 2 grown-up children have both just changed jobs, and both of them would only go to an employer who was willing to offer them hybrid working.
Very good. Lettuce, what's your leaving note?
Well, I'm interested to know how old they are and where they'll be in their careers in 20 years' time. I don't know. I'm very pro coming back into the office, but I know I come at that from an angle that my job isn't office-based in the norm. But speaking anecdotally, seeing friends that don't work in sort of the property and construction industries, everyone was very keen on the working from home at the start, and I think the gloss is really starting to go now, and people are far more keen to get back into the office 4 days a week than they have been. So yeah, I think the shine's wearing off, certainly.
There's a happy balance we need to try and achieve.
Yeah, I
Yeah.
think that's right. And Tim Shuey, I'm coming to you.
Yeah, I believe rarely is life black nor white. It often enough is grey, and I do believe there is room for everyone and every need and every requirement. You will always have empire building large corporations who like their employees in the office, and there will be demand for more flexible working space where the work location comes closer to home, so to say, and I think there is room and space for everyone. We're currently working on a very large residential development in Dublin, and that features a significant proportion of office space alongside some retail space that will cater for this future community. So we certainly see sub-centers emerging within centers, and there will be room for everyone. It's just finding what is right for everyone, and from an investment perspective, trying to have the flexibility and not just refinanceability or reinvestment ability to, if need be, to protect your capital.
And I have to echo that message from Tim Shuey, really, which is, I think there will be something for everyone in the office market, because I think we have always shown ourselves to be very adaptable, and that additional bit of flexibility that we'll all have to show will have to come through. But I think there will still be something there for landlords. I think there'll still be something there for tenants, and investors are still very keen to invest in offices, and they're still very keen to make it all work. And I think what our discussion has shown is that there is lots going on, but there's something there for everyone. So I'd like to close out now and say thank you very much for all our participants for giving us your time this morning. We really appreciate that, and we hope that you've enjoyed our discussion. This is part of a series, so we hope to see you back again with us very soon. Thank you very much. Goodbye.
Bye.
Thank you.
Bye.